Hello everyone, today is August 29th of year 2022 and this is Wyckoff Analytics presenting Wyckoff Trading Course Part 1. This is a complimentary session for fall 2022 semester, and with that, as usual, everything that we discuss during these sessions is for educational purposes only. Stop your recording, read the disclaimer in full. We're gonna have different groups of people attending this session today. The first group are the students who already signed up. So I looked at the roster, we're looking good, and I'm looking forward to working with all of you guys. Right away, I'm gonna say that this is not necessarily gonna be an easy course, all right? This is probably going to remind you a lot of the education or the type of education that you have had at your college years or graduate degrees. So there will be homeworks, there will be interaction during classes, you will have your even exam, for this semester for the first time. And it's going to remind you a lot of those, college years. All right. For those of you who are guests, you kind of fall into two categories. The first category is going to be, people who are thinking like, oh, I'm just going to check this complimentary session out and decide whether I'm going to sign up or not. I'm looking forward to discussing with you like the reasons and the benefits for you personally to sign up for this course. So a lot of people usually reach out and they just say like, Roman, what do you think? This is where I am. This is what I want. Do you think that this course is going to be beneficial? To supersede any of that type of questions, I'm going to say to this, yes, regardless of your level. I have yet to meet, a Wyckoff student who came to me, and usually people come and they say like, I've studied here, I talked to this person, I've read this book, I've read these articles, I've listened to this video, and so on and so forth. So far, we haven't found somebody who could kind of like be at the level of the courses that we are given, especially like WTC1, WTC2. So I'm kind of going to say that 99% of the time, my answer to that question, should I be taking the course, is going to be yes. This is a course that is building foundation as to how you read the chart, how you analyze the chart using price, volume, time, and sentiment. You could build up on that. You could start using the indicators, understanding the concepts. And then the second part of the group that is joining us is going to be people who just like want just this free session. And please enjoy. If you have any questions, reach out to us at wyckofassociates@gmail.com. We will be happy to address any questions that you have. And also, please use a lot of free materials that we have on our website, on our YouTube, on our Twitter, and we'll go through some of those things. But for those of you who are going to sign up, so it's $9.98 for 15 sessions. The alumni rate, meaning that people who already attended this course and you're coming back, and there are quite a few of our former alumni students that come back to us each semester, so it's $700. I would suggest the payment plan, 3 recurring payments of $332. That seems to be kind of like more manageable. All right, class details. We go into December with all of our classes. December 5th is the last class. All of our classes, live classes, are conducted at 3 to 5:30 p.m. Pacific time. So if you are outside of the US, and we have quite a few international students, then if you can attend live, that's great. If you cannot attend live classes, that's fine. You could watch the recordings and you will receive the homework slides and the class slides, about within 12 hours from the end of the live class. We're going to talk about the homework submission. Don't worry about this right now. But for those of you who are already students, I'm just quickly going to say that I want only one file. We'll talk about this in the PowerPoint format, in the PDF format, or in the Word doc. There is a specific way of how I want you to title your email. Again, we have a lot of email that come to us, so please don't produce extra work for us. Title your emails exactly in this manner, and then all of your homeworks will go into the folder, which I will later, before the class, go through. I usually go through all of the homework emails. Another very common question, is this session being recorded? Yes, it is being recorded right now. And yes, it will be posted later on tonight on our Wyckoff Trading Method YouTube channel. For those of you who are students, make sure that you have a headset with built-in microphone. During some of the discussions, and especially during the exercises, sometimes I would have a volunteer to talk to you, and we would go through the chart together. The access information to the recordings and slides will be emailed to all of the students, or for those of you who's going to sign up tonight or tomorrow morning. So you'll have the access to everything. And then, next Monday is going to be a more intimate environment, fewer people. So we'll talk a lot about administration of the course, what needs to be done, how to go about this, how to go about the homeworks, the exam, and so on and so forth. So we'll do that. All right, so what's the curriculum for the whole semester? Our main thrust is going to be in two subjects: market structural analysis, or Wyckoff structural analysis rather, where we're discussing such concepts as a change of behavior and change of character, where we are discussing the change of price environment, so switches from one environment like a trending environment to non-trending environment, what preconditions of that switch exists, what kind of visualization of the actual switch we should have, what does it mean to change the behavior, what does it mean if the change of behavior occurs, what does it mean to have a change of character, and so on and so forth. We also will talk a lot about the different Wyckoff events that are unfolding during the consolidation. This is going to be extremely important for us to understand what events create what kind of phases, as this is a timing tool for us to identify whether the structure is complete or not. Then the second big topic is going to be on price and volume, specifically supply and demand. This is where we're going to spend a lot of time on effort versus result. So the harmony or disharmony between the effort and the result is going to be probably the main concept while reading the chart. Is going to be applicable to the bar by bar analysis. It's going to be applicable to the swing by swing analysis. It's going to be applicable to the phase by phase analysis, and so on and so forth. Then we're going to quickly cover relative and comparative analysis. We don't spend a lot of time on this because a lot of you know this concept, but we're going to start from the basics there and kind of build our own understanding, Wyckoffan understanding, of how we should go about relative and comparative analysis. I'm going to show you some of the proprietary stuff on the comparative analysis, and we'll talk about filtering and scanning. Session number 14 will be devoted to trade management. So this is the introduction to the execution. Mostly we discuss execution in a lot of depth and details in WTC2 course, which is called Practicum. So it's all about execution there. It's all about practice. And then session 15, as usual, is going to be our Q&A session. If you have taken WTC1 course, tomorrow we're going to have another complimentary open door session for the WTC Part 2 course, which is all about the execution. Again, we call it Practicum. So what do we cover there? What do we usually do with our more advanced students? So application of the knowledge that we received from WTC1 is extremely important, and drills and exercises. I always tell our students, knowledge is not the skill. It just isn't. I see a lot of students that just hoard information and they withdraw from the actual, deliberate practice that needs to happen if you want to be profitable and consistent at the same time. And there is a big, big difference between students who just keep taking on classes, keep reading on books, keep reading on articles, keep going to the conferences, listening to the presentation, trying to find something that in their minds should be working. They justify this withdrawal from the practice by, there's a lot of useful information out there and I should get this. This has nothing to do with making money. So if you are one of them and you are capable in this moment, as I speak about this, recognize that this is who I am and this is what I'm doing, then you should come to us. And because at this level, WTC 2 level, we practice. We practice in each class. All of the homeworks is about practice. So for 15 weeks, you are just building the skill of recognition and execution, which is extremely important. We concentrate on the bias and timing. We concentrate also on trend following, how we are dealing with the trades that we are in once they are profitable. How do we maximize the efficiency of the of each trade based on the time and the price, and so on and so forth. And obviously, we do a lot of trading tactics and management in this class. Whatever they are, whether this is scenario building or it's a trade management or risk management or filtering and so on and so forth. So it's a very interesting class. Plus, I introduce a lot of in-depth material specifically on bar-by-bar analysis, which we call a significant bar techniques. We also talk about the swing-by-swing analysis, which is extremely important. Then we conduct anatomy of the trade, which is the post-trade analysis for students trades that they've done before. It's an eye-opening exercise. And then also we're doing the bias game. Bias game is something that probably a lot of you are already familiar with this product that we have. It's free. Go to our Twitter, go to our website. You could find it there. It's an exercise on skill building. So I would highly recommend this, even if you don't become our student. All right, specifically today, what are we going to do? So we're going through the introduction right now. The homework for those of you who sign up or going to sign up is going to be Jim Fortes' Anatomy of the Trade. I'll talk about this article in a second. Each class has a market update mini session. And this is where I'm going through the market and I'm applying Wyckoff method or my understanding of what is going on in the market. And then from week to week, you are just witnessing how this analysis unfolds. I think it's extremely important, especially for beginning students, to see this work, to see this type of analysis, because then it's not just the theoretical material that I give you each session, but you also see the actual practical implementation. You see some of my trades. I talk about those as well, whether they are winning trades or losing trades. I don't really care, because trading is trading. You are going to have losing trades, so you have to extract value from losing as well as from the winning trades. Then today we're going to talk about Richard Wyckoff, himself, who he was, why we study his method, what are the benefits of that methodology. We're going to talk about the main heuristic in the method, which is the heuristic of the composite operator. Then we'll switch to the main concept at the macro level, which is the price cycle model. And we'll talk about the behavioral market analysis. And I'll explain what the behavioral market analysis is. It's just basically an understanding of different intentions behind different market participants and how on the chart we could identify those intentions and the presence of those market participants, and we'll talk about strong hands, weak hands, institutional hands, retail hands, and so on and so forth. And as always, and as usual, we will have plenty of case studies to go about. And then in the second class, this is where a lot of work actually starts. This is where the tires meet the road, so to say. We're going to talk about the price cycle in details. We'll talk about the change of behavior, change of character. We'll start talking about the attributes of the accumulation distribution, reaccumulation redistribution. We'll talk about the phase analysis, Wyckoff events, and so on and so forth. And then, I'm going to give you the homework today. That is, again, Jim Forte's Anatomy of the Trade. This is a pretty good article in terms of the size, so I would suggest for you to start reading it right away, make a lot of notes, some kind of questions that you might have, accumulate those, and so on and so forth. But with class number 2, after class number 2, you're going to have the exercise where I'm going to give you charts, and you will have to label them. So all of this work that we're going to do in today's class, and especially in the second session, are going to be extremely important. Again, want to point your attention, for those of you who just joined us, yes, we are recording this session, and yes, it will be posted on YouTube. You could probably watch it within 12 hours or so. Okay, so here is your homework. Again, for those of you who are already students in this class, and for those of you who's going to sign up, you could find this article on our website. It's completely free. Jim Forte was not just a colleague. I mean, I met Jim in 1996, I believe, at Golden Gate University at Hank Spruden class, and both of us were students at that time. Jim was finishing his CMT designation, and as a part of that designation, he wrote an article in the MTA journal, and this article was just, I personally consider this article the best written article on Wyckoff price structural analysis. So even if you not going to sign up for the class, please read this article. It is well written, and again, I would say, like, if you're going to read one piece on Wyckoff, this would be it. All right. A quick comment. There seems to be a lot of background noise. Do you guys hear any noise? Any background noise from me? I mean, I don't have anything here. I'm totally isolated in my office. No, okay. All right, well, for those of you who have some kind of background noise, so maybe on your side, so just check it out. All right, let's do the market update. And let me ask you guys, I'm just very curious because we have a bigger audience for the open door session. How do you view the trend? What is the trend right now? Is it up? Is it down? Maybe something else? Write it down in the questions window. Okay, down, short-term down trend. Okay, sideways, consolidation, sideways, probably the turning point from down to up, down, sideways. Okay, well, yeah, we have quite a few opinions here, quite a few ways to talk about the downtrend. So we'll usually talk with students about different ways of thinking about the trend. So for instance, I usually would ask students, what is the long-term trend? And you might be thinking, okay, well, how do you define the long-term trend? And that would be a very, very proper question. So to me, the long-term trend has started at 2009 low. This is the long-term trend. So really quickly, let's just do this again. Long-term trend is what? Down? sideways or up. And by the trend, if you're thinking about the trend, the uptrend is going to be higher highs, higher lows, a very simplistic technical analysis definition of the trend. I don't want to overcomplicate this. If you could add, a moving average here and just to show like, oh, a 200 moving average or whatever moving average you're using is still up sloping, then yeah, you would correct. Since 2009, we're still in the uptrend structure. We would have to break the low in June in order for us to have some kind of indication and confirmation of the downtrend. Okay, well, what about intermediate trend? So long-term trend is up. What about intermediate trend? Down. Down, 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 down. Okay. Yeah, and I would say that the intermediate trend is all of this. This is what we're looking for. What's the structure here? Well, we are seeing lower highs and lower lows. And that's how simplistic this is. We have just had a change of behavior right here. It's not confirmed yet because the confirmation would come with the reaction. So we'll need to kind of like figure this out. But I would say that there is no switch for us, and we switched into the downtrend on this bar right here. This bar was confirming this whole downtrend, but these were the two most critical bars for us after the conditions have formed to the left. That we are going to have some kind of downward action. By the way, for those of you who are interested, we called here for the downward market, okay, and the question would be like, well, where did you call for, let's say, like the best rally? So we called at the time this rally, and we called this rally starting in May, and during this whole period, we were saying we're going to have the best rally since the beginning of the downtrend. Now, the next question that should be kind of like posed by you in your minds is how? How did you see this in both cases? Well, I mean, that's what methodology is all about. It's developing the skill of reading the chart where you could see the institutional forces that represent buying, demand, and selling, supply. And the way how the price reacts to those two forces, the interaction of those two, is going to be the definition of the directionality on different time frames. And that's how we are reading the chart. So a very, very forgotten, art of how to read the chart, but we most definitely structurize this a lot, and that will become evident, through the WTC2 and WTC2 classes. What about a short-term trend? Where are we with the short-term trend? And I'm going to give you a hint. We've been in the short-term uptrend or rally since June, since middle of June. So where are we right now? What is the short-term trend? Down, 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 down. So this seems to be very straightforward, right? So last commitment to the upside, we see the deterioration of the momentum and the last swing, and then we have the reversal on this day. So from that day on, we are in the downswing. So the short-term swing is to the downside. So long-term secular view is still big up. The intermediate trend is down. And you could make an argument that, you might be in some kind of trading range, and we'll talk about this. So downtrend to a trading range. And then a short-term trend is most definitely down. So that's how simple, and quickly you could go through the chart and just basically define what the current environment is. Okay, so now let's talk about the rally itself. This latest rally since mid-June. So we started talking about the possibility of the rally even before that. And we said that this rally is going to be the best rally in this trading range. How come? Well, we're seeing that demand definitely comes or came each time the price touches the support. We're seeing also how throughout this whole period there is diminishing supply signature from one low to another low to another low and to the actual testing of the ultimate low. We also see how we're building the causality for this rally, and we'll talk about the causality, later on, and we'll discuss this more as to how to measure the causality, what does it mean to create the cause, what's going to be the effect of building that causality, and so on and so forth. So with that, as we're seeing, selling is diminishing throughout the volume signature in this area specifically. We're seeing some kind of climactic stopping action with the increasing downward spread, with the diminishing thrust to the downside from one low to another. And this is a very important concept for the preconditions of the reversal. Then we're seeing how the initial rally off the bottom, this one right here, is so much better than the initial takeoff that we had on the initial stop in action. And then we're seeing that the stop in action right here actually comes maybe around 1/2 to 61.8%. This is, kind of like an analyst sarcasm right here. Then any prior testing actions. Look how deeply this test is. This depth of the test defines the ability of the rally to extend beyond the resistance. So we already knew that our targets are probably going to be around this resistance right here and most likely going to be an up thrust, which had happened. So we reoriented, short term right here on the reversal of this particular bar. So that was, a really good call there. You could also see that the initial test at the intermediate selling climax also was pretty deep. So looking at how the test has unfolded, and especially look at where we have opens and closes here. I mean, like this is definitely like 1/2, not even 61.8. So from that type of testing, you expect that this is going to be a better rally. Most definitely that's what has happened. Now, the next question is, usually the best rally is going to be associated with the change of behavior. Again, the concept that we will be studying in the next class. We are seeing overextension. We are seeing how the downward spread, the downtrend has been overcome, and we see multiple progressive closes to the upside. So this means that there is either still some buyers that are willing, to push the price higher and they're willing to buy higher, which is a good sign, or if demand is deteriorating like it was deteriorating in this case, supply is still not that present and it's still not capable of reversing the price right away. So we're just making a note and observation about this. Now, what happens here? Our comment, into this particular low was way more bullish than the comment after the Fed meeting, after the Jerome Powell's comment on Friday. Why? Well, because when we look at the downward spread here, and let's say we're comparing it to the previous attempts to reverse and to push the price down, instantly you see that the downward spread is diminishing in most recent case. We're seeing that supply signature is definitely less or somewhat less, and that we are coming to the support which acted before as the resistance. This area right here is an extremely important support for us to observe. So it was, a way more bullish picture as it was unfolding. And obviously, market is all about uncertainty. Events could unfold that you don't anticipate. plus the reaction to those events by institutions could unfold also in a way that you don't expect it. And I think that, the Powell's comments is that type of the event. It reminds me a lot of the CPI event right here, and also of the a little bit of the Fed announcement right here in this area. So all of the three circled areas associated with some kind of event, some kind of catalyst, and usually the catalyst, which is the macro catalyst, either the Fed or some kind of inflation numbers. And you could see that in each case we had a pretty significant drop, which commits the price below the support. In our case, the support is acting right here. So yeah, we see that commitment to the downside. What did we see today? Did we see the stop in action? Maybe that yet to be confirmed. But if we would just be thinking about close to close, then we most definitely don't see more of the follow through to the downside rather than some kind of more significant stop in action. So we need to think about what might happen tomorrow, right? So we're thinking short term, and then we're thinking more intermediate term. Attempts to rally today did not materialize. So we still should acknowledge, despite of the presence of the demand, there is demand present in today's action. Just because the bar is contracting, there is no big follow through to the downside, but the gap down and then the intraday action. That it's still weak short term, and we need more information. We need to see how this is going to unfold, let's say tomorrow and this week. Would we have an attempt to stop here, let's say maybe like around this area right here, this support cluster? And we have the reason to talk about this, a possibility of the stop in action right here. Why? Because the volume signature was relatively high. Relative to what? Relative to the previous downward bars, relative to the previous reactions, it was relatively high. So there is a presence of the demand. So somebody was buying. And actually, when you go to the stock level and you start looking at a lot of charts, and if you do the down to the top approach, right? Not top down, but down to the top, you could see that there are a lot of causes, bullish causes that were built, for the last number of months. There are specific groups that are acting extremely well. So you definitely should be in some of the positions, I would say, depending on your time frame. If you're a long-term campaigner, most definitely you should have, at least, between 40 to 50%, maybe 60% committed to the best groups, the best stocks in those groups, and you should already have, somewhat of the significant profit there, because the groups that were devastated and became so weak and oversold during this downtrend since the beginning of this year has gotten themselves into extremely oversold condition. And this is where institutions start participating, start buying, start pushing, that starts pushing the price up. So if you've been picking the stocks up like we did at the bottom right here, you should have anything between 30 to 100% on this specific stock. If you're picking like technology stocks that were oversold, healthcare stocks that were outperforming, energy stocks that were the strongest during the downtrend, and so on and so forth. And we'll go through those, from time to time. So what kind of scenarios are we looking for here? Could we stop here? That would be the best bullish scenario. Could we have a bar that starts intruding into the news bar? That would be also a really good bullish case. But now that with this bar and the increase of the supply, we definitely need for the bulls to create some kind of structure here, some kind of consolidation. Could we possibly just attempt to go up and overcome the high of this bar? So this would be extremely bullish. And then test again. And test preferably on a higher low with the lower supply signature. so that we would see that the sell-in deteriorates. And then from there, break to the upside and confirm the continuation of this rally. So this is the best bullish scenario. The second bullish scenario, which I don't mind either, is some kind of attempt to rally and then subsequent failure and kind of like a more laborious move to the downside into the end of this swing, preferably into the higher low, and then from here starting to go up again. And then we'll talk about this as being a big, huge trading range, and this is some kind of minor sign of strength as an upthrust action in phase B. For those of you who are familiar with phase analysis, going into the reaction into the actual phase C of the much larger reaccumulation in a much bigger secular uptrend. So we'll have to see this. This is scenario number 2, bullish scenario. And scenario number 3, which is bearish scenario. How would the bearish scenario look like? There are 2 requirements for that, or maybe 3 even. Attempts to go up, and then failure. So we need to commit to the downside, and we need to commit to the downside kind of like in the same manner as we did here, where the price and specifically the close extends away from the support, and that commitment happens, further down as the price goes down. So we see that, for instance, here, we see that here, we see that here, and it's a very, very kind of common pattern in the downtrend or in some kind of areas of volatility where commitment to the downside, extension of that downswing starts confirming the character of the bear market. And then we still go down, and we go down on the volatility that is increasing and on the volatility that is way, way more vertically down. So like verticality of the down move would increase, right? So the reaction in the bearish scenario here would look much more threatening than the rally itself, preceding rally. And then the third requirement is to commit below, to produce some kind of sign of weakness, which would tell us that, yeah, the sell-in actually overwhelms buyers, and the sell-in pushes the price not only to the support, but actually it commits the price below the support. So that's what we're looking for in the bearish scenario. Okay, let's go to somewhere else. Usually we do the comparative analysis. Let's just go to Russell. Russell has been extremely strong here. Neela is asking, okay, is there some kind of sprint scenario? Yes, there could be a sprint scenario. I would say that if we're talking about the reaccumulation here, then the strongest asset like Russell would most likely have last point of support. The weaker assets are most likely to have a weaker scenario, which is the sprint. But how would the bullish sprint unfold here? Again, I want to see a laborious move to the downside in any of the bullish scenarios, right? And then from here, there could be some kind of local sprint or more global test, and then continuation to the upside. So is it possible? Yes, possible. But I think that we need a little bit more information about the character of this reaction in order for us to figure out whether the sprint or last point of support or a true sign of weakness in the bearish scenario is going to happen. So Russell is most definitely stronger. I don't see as much selling in Russell as, let's say, in the S&P. We started selling off here off the top, and the volume signature is still lower. And then, into Friday, that volume signature has not increased that much. So with that, I would say Russell is most definitely, by the character and by the price structure, is stronger. Okay, let's go somewhere else. Let's go to the 10-year yield. So we stated that we were looking for some kind of trading range. which would exhibit some kind of strength, meaning that it would have some upthrusts in it. So here is one upthrust, and this is most definitely an upthrust. Change of behavior, and that change of behavior defines the high of the buying climax and the low of the automatic rally. Then we're still seeing how the downward spread is contracting, suggesting the rally. So there is still very strong buying going on there, and then a very well-defined upthrust. And look at the extension of this upthrust. I mean, it just basically tells us that I'm still strong. This still should be built as the case for the potential reaccumulation, unless you start seeing some signs of weakness. And you could make an argument that this spring-like event, could be a spring or minor sign of weakness. That yet to be confirmed, but we said in our classes that we should approach this area right here of the local break and then stop here. And here, there's going to be for us a decision making here. Are we creating an upthrusting environment, or are we just stopping here because originally there was a break to the downside, stopping action, so supply was present? Could it happen here? So far, we are holding, and that shows strength. So the next thing is, could we overcome the buying climax resistance? And that definitely puts the pressure on the market. I mean, this whole area right here, the US dollar and the interest rate, I would say, like, the most go-to charts for me to identify some kind of influences on the stock market. So very, very important chart for us. Let's look at gold really quickly. There are quite a few questions about the gold. So the gold analysis went like this. We have not seen anything interesting in the downtrending environment except for some swing and intraday trades to the downside until we have had a change of behavior rally. And please note how the change of behavior rally, I mean, we just had it in the stock market. There is an overextension in the stock market above the downsloping resistance. But then look at the character of this rejection. And look at the volatility that brings us to the support. So we said that this is something that we still need to test. There's so much supply that came in that the testing should take place. It was good that the price has stopped right at the support level where previously the price has stopped as well. It was good that we have a demand tail here as well, that the volume signature was not the highest and it was actually diminishing throughout this whole downtrend. That suggested that there might be some kind of testing action in the trading range. The trading range showed absorption. We've talked about that, and our call was to the upside. Actually, I had a really good futures trade right here. This was the trade. It was a swing trade just to kind of come in, quickly take on leverage as much momentum movement as possible. And then after that, again, a change of behavior, which is local, with very weak demand that cannot produce a meaningful rally and retraces only to 1/2 of the change of behavior reaction. Break to the downside, confirming that assumption. Again, in the next redistribution, we don't see a lot of demand, so our call is to the downside with acceleration, just because we are breaking all of those supports and we go to the global support, and we're stopping here. So for now, I would say, and my argument is that we're in some kind of trading range. Now, there are some possibilities and scenarios that as we consolidate here, we might overcome the resistance, we might come back to it, but ultimately it's the bias in this consolidation that will define the next big move. So we are anxiously waiting for the structure to start developing and to see what kind of bias it could bring us. I would say right now, if you're an intraday trader or short-term swing trader, I think there are some opportunities. You could definitely trade those swings. But as a long-term campaigner, I would say that you still have to wait a little bit for a confirmation of one way or another. All right, let's go to oil. And oil has been an interesting case study for us as we are most definitely identifying the buying climax with ease after the climactic run on the climactic volume signature. The change of behavior is suggestive that we're going to go into the trading range, one of the most important concepts in Wyckoff method. And we are seeing how the automatic reaction is being formed, followed by the secondary test, which does not retrace majority of the move to the downside, suggesting again, not just the trading range, but also suggesting maybe a distributional formation or some kind of reaccumulation trading range with a lot of elements of weakness. And around this area right here, my call for oil was that we are going to have our last rally into the upthrust condition. So here is our upthrust condition right here. And then after that, we're going to go down. And not only that, we're going to go down to somewhere around 60. And it seemed like, you know, and I also, on the top of all of this, as I was talking about this at the, at the end of April, beginning of May, I said that by summer end, we're going to touch 60. Obviously, it has not happened. I doubt that in a day or two, we're going to have that. But that's not necessarily, the call where you cannot make the money, right? So think about the call that was made here. We said, we're going to have the rally. Can you trade the rally? Yes, you can. We're going to have an upthrust action. Can you trade the upthrust? Yes, you can. You just wait for some kind of reversal like this or this, and then you wait for the pockets of the retest of those breaks to the downside, and all of that has happened. And you stay in the trade by trade management rules until the point where you exit this trade. And you had to exit the trade somewhere after this reaction. Why after this reaction? Well, look at how the price starts to go down, but not with the same type of intensity. If before we had the breakdown bars that were, significant, they were expanding in terms of the downward spread, they were committing to the downside significantly below the areas of the support. And this did not produce this type of character or this type of structural look. If anything, we're shortening the thrust here, we're shortening the downward spread, and look at the volume signature. If before and after a regional upthrust right here, supply was increasing, selling was increasing, then we're seeing decrease of selling and decrease of supply on the chart. So that suggested for us that there might be some kind of stop in action, and we're gonna at least attempt to go up. So the key in what is going on right now, after those two trades that we've done, is to understand the levels of selling where supply might come and where we could experience some kind of pressure from sellers. Where should it happen? This bar right here. And I think anything between 100 and 105 is a very extremely important area for us to see how selling might potentially occur. What kind of result the selling is going to produce? Would the price, touch the lower boundary of this zone or the high boundaries and then upthrust? So that would be still suggestive of the continuation to the downside. And then obviously breaking down, having different levels of the confirmation, like for instance, upthrust and then reversing, confirming, then confirming again. So something like this. So that would probably be suggestive of continuation to the downside. On the upside, we're seeing how we diminished the thrust to the downside. So that expectation for the rally is unfolding right now. I would say that we don't necessarily like the demand signature. We want it to be a little bit higher, but if price moves to the upside without a big presence of the supply, what does it mean? It means that the sell-in is at such a low level that a lower level of the demand and a lower level of buying and a weaker buying could actually push the price up. a concept that we will be studying in the second part of our semester. Let's go to Bitcoin, also a very interesting case study. And by the way, I want to say for those of you who are crypto traders, we do have the crypto Discord, which is led by our crypto asset and trader Alessio. He is fantastic, adapting the Wyckoff methodology to crypto trading. So check it out on our website. Find the Crypto Lab. Reach out to Alessio, ask any questions. There is always a lot of discussion and a lot of education that's going on the daily basis. So check this out. So what do we see here? These blue lines are long-term support. So we see how the price actually stops in this zone. And it stops in the correct manner. So we have the most important bar, which is still acting out for us. And then after that, diminishing supply and diminishing momentum to the downside, stop in action. For the time being, right here, we said that this is going to be the lowest low. And from here, we're probably going to have at least an attempt to go up, at least an attempt to rally. The rally in itself is not that impressive. And there are multiple tests that we see at the low level and then at the high level. It's in this area right here that we started saying that actually supply is increasing. And the rally, the demand is decreasing. And then the price kind of follows in that direction, right? So for instance, when we look at the demand and the decrease of that demand, what kind of price action does that produce? It doesn't produce a big expansion to the upside. It doesn't produce a big expansion in the momentum to the upside. So that was suggestive that we're going to have the reaction, and with the reaction we might see acceleration to the downside, and we said that we're going to break this support most likely, which we've done. So with that, what's the most recent price action that we would be discussing? Well, first of all, Bitcoin is weaker than other crypto assets. So a sprint in this case is, very possible. Secondly, our second observation on a more short-term basis, this was the most important bar. This is the most important bar since the low and since these two bars right here. It takes us most definitely down and negating these two attempts to rally. And then after that, look, there is no demand. And then there is just a continuation on less selling. So I wouldn't be surprised if the price, attempting to rally from here, will try to rally and then fail again and fail even to this level right here. So that is most definitely a possibility. And I would be thinking that here we might have some kind of, attempt to stop as well. Demand should come at this level, and you should be probably be thinking like, okay, long term, is this the spot for us, to start, putting on the position or adding to the position? Yet to be seen. We need to approach this, and we need to see how we're approaching this. Is it going to be on big volume? Is it going to be on expanding supply? Is it going to be on a big bar to the downside, and so on and so forth? So, but for now, the swing definition is to the downside, and then the whole bias here is kind of like dependent on that confirmatory sign. Okay. Sayed is asking, so you wouldn't anticipate and buy early? Actually, yeah. I mean, like, I bought Bitcoin and a little bit of Bitcoin, but mostly other cryptos just because they were stronger around this area right here. So this was my original position. I usually, right here, I would be considering either add-ons or trims or exit. So that's kind of like what at this place we would be thinking. At this place right here, we're considering entering, point of entry, or adding to the position. Low risk, extremely oversold condition, you have to take a stab at this. And again, not necessarily at Bitcoin, because once we talk about the relative and comparative analysis, you'll understand that you could look at the Bitcoin and say like, yeah, I'm seeing there's some kind of potentiality for the rally here, but you could go to another asset and your selection could be way better than Bitcoin and buy something else, and that's exactly kind of like what I've done. Okay. All right, and that's it. Okay, Bitcoin weekly chart shows a completely different picture. Actually, all of the charts on higher time frames show a completely different picture. It could be fractal, yes. Sometimes they happen this way, but this is different. Currently we're still in the downtrend for the Bitcoin, and I probably failed to mention this at the beginning. But that's the original definition that we still have. So there is no confirmation yet of the accumulation. Yes, we are trading this trading range as if we had an expectation for some kind of rally. It has happened. The price rallied from 18,000 to 24,000. So we're taking advantage of this. We trimmed the position in the expectation of the reaction. And now we are waiting to see what kind of character this reaction is going to have. Would it stop around the area of the previous support and produce either a spring or last point of support or sign of weakness, and then we kind of go from there. So as you could see, Wyckoff analysis is fluid. What do I mean by that? You have to be able and be flexible to go from one bias to another, because sometimes in the trading ranges the biases change not necessarily in phase A or B, but they could change in phase C or D, and that is something that we study in the WTC2 practicum with our advanced students. Okay, I think that's it for our market analysis. Let's switch back to our slides. And if you are a Wyckoffian and you want to join our community and be a part of the weekly market analysis, which I conduct together with Bruce Fraser, please check out Bruce's blog on stock charts. It's a phenomenal read. You should, if you are a true Wyckoffian, you should know about this blog. You should have read some of it or all of it. It reads like a book. I would just start from the beginning and just like go through all of them. So each Wednesday at 3 p.m. Pacific, and usually all of our live classes start at 3 p.m. So you're most definitely welcome to join any of the classes. But specifically on Wednesday, Bruce and I discussed the markets, and we discussed them from the macro point of view, from the technical point of view, from the chart reading point of view. Then we go in a top-down approach to the sectors, industry group levels, and then to the stocks level. We also discuss, futures, some of the cryptos, if necessary, and any other instruments that are of interest to our students. So quite a lot of stuff that goes into this hour and a half for this class. So check this out, and you're most definitely welcome to join us. Also, a spin-off out of the WMD is the Wyckoff Market Report. Again, for those of you who are true Wyckoffians, you will appreciate this. It's a scanning engine that Joni Scan, one of our content contributors, does on the weekly basis, daily basis, and he has scans for different Wyckoff structural spots, like a spring, last point of support, up thrusts, breakouts or breakdowns, and so on and so forth. And he shows this in his report, and he creates the watch lists for you of those stocks that are behaving in a specific way. So you could use this market report letter in different ways. You could just look at the health of the market just in general by the population of the stocks in the specific scanning category, or you could use this as your watch list. And the way how I work with the report is I just go through the list, through the watch list, and I create my own watch list. So that's kind of like the most valuable to me. All right, let's jump. We're at 4 o'clock. Let's jump into our theoretical material for today. Let's talk about Richard D. Wyckoff. And by the way, for those of you who have just joined us or just recently joined us, please don't forget that this session is being recorded and it will be posted on our Wyckoff Trading Method YouTube channel tonight. So check this out if you need to go or if you want to watch this later on. So we are recording and posting it. So Wyckoff was most definitely very interesting, almost like enigmatic in certain ways, personality. He started his career as a running boy, you know, at the bucket shops, if I remember correctly, and he ended up being an editor of the magazine of Wall Street. He ended up being kind of like a codifier of different market techniques that were done by the best stock and you know, commodities operators at that time. He had access to somebody like Jesse Livermore, James Keane, you know, those type of campaign operators, and just observing how they conducted their campaigns of, let's say, taking on the huge supply of shares, marking up the price, and then distributing those shares at the much higher prices. And this is an art. This is not that simple as it sounds. But by observations, he has created a codified number of rules by which we should be analyzing the market and by which we should be selecting specific stocks. And this has become a foundation of the methodology. Obviously, methodology has developed even after passing of Wyckoff in 1934. And there were a lot of brilliant, excellent minds that came after Wyckoff himself. The first one was Bob Evans, you know, apprentice of Wyckoff at that time. He has inherited Wyckoff Associates and all of the material, and he has developed a lot of the concepts. So, is he still alive? No. Bob Evans has passed away, but we had a chance to actually talk to his son, and I believe that he has presented to TSASF. This is a local Bay Area technical analysis organization, and it was quite interesting to hear him as he actually was. He was too small, but still he caught the glimpses of how close his father and Wyckoff were at that time. I would suggest also the work of Stella Asoba. Stella is a CMT, chartered market technician, and she wrote two wonderful articles. One was on Richard D. Wyckoff, and the second one was on Wyckoff and Livermore. We invited Stella to conduct a presentation for the Best of Wyckoff conference in 2019, which, you know, she did so splendidly. You could find the whole conference on our website. It's free, so go explore. We actually have all of the Best of Wyckoff conferences for free right now for you guys, with so many great speakers, including David Wise, who passed just recently, including Gary Dayton, Gary Follett, Bruce Fraser, Hank Pruden, and many other big names in the Wyckoff methodology. But again, I would most definitely refer you to Stella's article in Stocks and Commodities, It's a 5-part article, and she almost like wrote a biography of Wyckoff, from different points of view. It's a fascinating read, and it gives you a really good perspective, as to who Wyckoff was and what he has created. So as I said, Wyckoff was a very kind of like enigmatic figure. He has done a lot. He has accomplished a lot. But again, his main contribution to us was the closeness to different type of operators, like Jesse, like James King, and so on and so forth. He analyzed their behaviors and created this Wyckoff course or Wyckoff techniques. He described a lot of those techniques in his books, in his articles, in his magazine of Wall Street. So we have a lot of written material that came to us from that era. He also introduced the concept of the composite operator. And this is an extremely important heuristic for us. So we'll be discussing this momentarily. As I mentioned, he had written quite a lot of books. So a lot of students ask me, which book by Wyckoff should I read? And I say right away, none of them at this level. If you're a beginner, I really would like you to concentrate not on the Wyckoff books, but on the more updated material that we have. Grasp the concepts through the modernized material first, and then go to his books, because his books do not contain, a step-by-step, manual as to how we should be behaving in the marketplace. This is more of kind of like observations, certain techniques that he discusses, like in the stock market techniques. This is probably one of the most valuable books just on the techniques alone, or tape reading, also, very valuable book. Wall Street Ventures and Adventures, more kind of like a story of self, of Wyckoff himself. As I mentioned, he's been an avid writer, editor. The Ticker was the first publication that was extremely successful. And he has met so many great technicians and traders and campaigners of his times. For instance, this particular article from the December issue of 1909 has an article on William D. Gann, who he knew and he had access to. And then I said that he has created the magazine of Wall Street. Unfortunately, his worst trade was his second divorce, where he lost this magazine of Wall Street and other possessions, to his ex-wife, which is obviously unfortunate. The magazine of Wall Street ceased to exist around like mid-70s. When the family decided that they're not going to continue with the magazine, but we still have records, and you could find in the public domain, some of the articles from the magazine of Wall Street. You could just Google that. The work that I usually say that you have to read, and again, not at the beginner's level, but more on the intermediate level, is his book. Is his course, the original course by Wyckoff that came out in 1931, 32, and 33. So remember that Wyckoff passed in 1934. So when after his devastating divorce, he lost a lot of things, a lot of copyright. So it forced him, I think, to create this course. And this course is also, very foundational. So here he talks about how to read the chart. Now, why do I say that this is the material for intermediate students? Well, again, because this is all outdated in terms of how it was written, in terms of how the charts are being shown, in terms of how the concepts are being presented, and how it's all systematized into some kind of approach. So I, again, would be suggesting for the beginners, get the thrust of the knowledge from the modernized material, and then, or once you are at the intermediate level, go to this more specialized material, read, and it will make a lot of sense. Okay, let's talk now about the composite operator, this heuristic that Wyckoff brought to us. And this is, these are the pages from the magazine of Wall Street, from the article which is called The Composite Man by Richard D. Wyckoff himself. So who's best to explain, the concept, but the man who actually, called it. So who is the composite man and where can he be found? He consists of 2 million personalities, so scattered over the face of Earth. So at that time, imagine how many traders they had, what kind of communication they had, how it was all so delayed, how expensive it was to trade. So regular folks were not able to participate that much. So he's just describing here that there are many, many traders around the world that trade, and all of them at any point of time could be a part of the composite man heuristic. Some of his components parts are richer, more powerful than others, right? So these are your institutional traders, investors. Let's call them investors. Some are noted for their foresight, intuition, shrewdness, conservatives. I would say that foresight and intuition are analysts. And then shrewdness, probably, and as we read further, some are for the daring, reckless quality of their moves, so speculators. These millions of personalities form one, omniscient, who sways the market, meaning that all together, as a group, as a herd, with so much money, this group has the capacity to move the market, sway the market, crushing those who do not know and will not learn how to benefit by him, and crowning with profits and income those who do. So, in other words, Wyckoff's definition of the composite man is something different that I was taught and I learned, back in the mid 90s as I first studied Wyckoff methodology. There was kind of like this idea, which is still persistent and which is a little bit irritating, that we're still talking this language, legacy language, which is completely incorrect. The original composite operator idea that I've learned was that there are institutions and there are retail people. And then, institutions are strong hands and retail people are weak hands. This is way, way out of the line and absolutely incorrect. There are a lot of retail traders that are great traders that are making money on the specific trade, making money consistently in their portfolios. So how would you be considering them weak hands? You can't. And there are also institutions, and I work in a hedge fund, so I co-manage a hedge fund, and I could see, just looking across the field of different hedge funds, how their performance is. And a lot of the hedge funds not only underperforming the market, but also they could be underperforming with the absolute negative result, let's say for the year or for a number of years. So are they really strong hands? No. So in that particular case, they are weak hands. So from that perspective, this whole idea, and if you still think about this in this way, that strong hands are institutional hands and weak hands are retail hands, please change that. There is no reason to think like that. And I'm giving you the original source here that introduces this heuristic in the correct way. These are different investors, different analysts, different speculators, retail people, institutional people who are on the correct side of the price cycle. That's how I would define a composite operator. And then everyone else who is on the incorrect side of the price cycle could be considered weak hands. All right. So what does the composite man or the composite operator do? I mean, obviously, it's not one man. It's not a group of men who are conducting kind of like this, big control of the whole big composite man, group of different traders, retail people, analysts, and so on and so forth. No, it's a heuristic that is being formed in the space of non-communication. So people don't necessarily, all of them communicate with each other, but they're on the same side of the trade. And what they do is by buying together or by selling together, they are producing a specific price structure. And Wyckoff said that the composite man carefully plans, executes, and concludes his campaigns. So think about the times when that he was developing his methodology in. This was the time where the legislature was way too liberal, for the stock market operators to manipulate the market and the stocks in such a opportunistic for them way, profitable for them way, that this definition of carefully planning, executing, and concluding the campaign makes sense. Now, institutions in our current age definitely also plan and execute and conclude their campaigns. And what is happening there is that they're using a lot of the data from their analysts. They're using a lot of the data from any type of historical studies. They're executing based on their models that they've developed, back tested, and so on and so forth. But I could say to you that majority of institutional research comes kind of like from the same place. From the Wall Street, you're going to have your macro, your fundamental, and your technical analysis that delivers some kind of data to the decision makers, like hedge fund managers and so on and so forth, and then they act on that. So in this way, there is some kind of herd mentality, institutional herd mentality, that we could most definitely observe and that we could use to our advantage. If you understand how institutions are behaving, what their intentions are, how are they behaving in the specific price structural spots, you will know what to expect, at least short term. All right. With this, let's go to another subject, a bias game. I mentioned the bias game. So the bias game is a skill building exercise, as I mentioned before. We conduct the bias game on the weekly basis on Twitter. You could sign up to our Twitter handle at Wyckoff Analysis, and each Wednesday a bias game is released as an assignment slide. So this is the slide where you are given a chart and you should vote whether you think that this is an accumulation or a distribution. You could see how your peers are voting as the vote unfolds. And then on Friday, we present to you the solution slide with our labeling, with our Wyckoff story, which is the explanation of how we conducted this analysis and what are the areas, of observations that we need to concentrate focus on. You could also play the bias game, and we have at this point almost 160 bias games. You could play those one by one from the beginning on our website, wyckoffanalytics.com. Again, all of our students go through this, and specifically in WTC2 class, we actually go into a very deep discussion of all of the bias games from week to week. All right, so let's now talk about the objectives of our analysis. Like, what are we really doing when we look at the chart? I know this is going to sound very strange. Well, here's the chart, look at that, and maybe like look at the price and volume. define some kind of, concepts there, convert those into some kind of definition of accumulation or a distribution. Well, it's a little bit more complicated than that. Actually, it's a lot complicated than that. There are certain things that we need to do as we observe the chart. And in tomorrow's class, I'm going to talk about how we are observing the chart. Usually, people are not capable of observing a lot of data points on the chart. I mean, like if you think about the chart, how many bars do you have on the chart? Each bar has the close and open, high and low, definition of the bias for the candle, definition of the volume, up or down, the absolute number for the volume. You also could have the duration, the time. And then this is just primary data. This is the primary information. You could also have secondary information. So for instance, if this is an up bar that has, expanding spread, that's a secondary observation. And that spread expands, let's say, above the high of the previous bar by how much? By how many points? By what percent, and so on and so forth. So this is an example of how you expand your observational skills. Then after that, you need to be able to make some kind of deduction. So for instance, if you are observing the chart and you see in the concept of expansion of the effort and decrease of the result, you know that a potential reversal might be coming soon. So that's the type of the deduction that we need to make on the top of our observations. And then just trade alone side of the smart money, which also sometimes surprisingly could be difficult, even if you know what you're doing and you've already practiced it, right? And it all goes into our mindset. Mindset is probably the last thing that I would want to teach you. Some students come to me and they say like, oh, okay, well, I think that I'm making mistakes because I am mentally doing this or not doing this. And I usually put the chart in front of such person and I say, okay, what do you see here on the chart? And then right away I see the level of the scale of observations, deductions that could be easily kind of extracted from the chart. And from there, my usual advice, I yet to meet the person, who I would say, yeah, let's stay on the mindset. But almost 100% of the time, I say that you still need to build more skills or more knowledge. So I would most definitely concentrate more on chart reading first, get to a very, very high level, and then start thinking about mental pitfalls that all of us have. So how do we start our analysis? We want to understand where we are in the price cycle model. We want to understand the behavioral market analysis. Those are the behaviors behind market participants. We want to understand the trend analysis as well. We want to understand where the change of behavior and change of character happen, and we want to understand different type of schematics. Those are the schematics that are going to be schematics on timing, identifying different phases of the trading ranges that unfold, and different Wyckoff events that confirm that type of timing. All right, well, let's talk about the price cycle. Again, a quick note for those of you who has joined us just recently, this session is being recorded and we will be posting it on Wyckoff Trading Method YouTube channel tonight, so check it out. So this is the most simplistic depiction of the price cycle. As you could see, you have different areas here. An area of the accumulation. This is an area where there is an active exchange of shares between strong hands and weak hands. The weak hands are capitulating in strides throughout the downtrend and specifically into the climactic action of the downtrend. This is where their emotional tolerance for pain is so much less, so they're just dumping their shares. We'll talk in more in details why that happens. And at the same time, the strong hands are buying because they're seeing a lot of long-term value and short-term liquidity. And then throughout the whole trading range, weak hands are going to be exhausted with all of the ups and downs. They will be shaken out multiple times, or they will withdraw even much faster from the asset that has shown them some kind of unprofitability. And for their emotional comfort, they usually withdraw and go away. I'm sure that all of us have done this. I know for sure I've done this. And this is normal. So there is no need to hide behind some kind of egoic thought like, oh, I've never done this. If you're thinking like I've never done this, most likely this is just a defense mechanism. So you have to look into this. All trading, just kind of like from a very, very high mindset point of view, is all about you. I usually say that trading is kind of like a mirror of self. Whatever mistakes you make in trading, you make similar mistakes in life as well. It's kind of like based on your behaviors. So a pretty fascinating topic, which we only can discuss after we gain a lot of technical proficiency. Okay, as we go through the exchange of shares in the accumulation area, there comes a period where emergence of the new trend happens. Usually by that time, a big significant chunk of shares have been accumulated by strong hands, and that supply is in the vault. This means that they are not necessarily selling it, they're keeping it. And this is the process of absorption where by the time phase C and phase D happens and the emergence of the trend unfolds, we would say that the stock is in strong hands. Now, the emergence of the trend is going to be associated with additional institutions recognizing the moment of the new uptrend, and they start building their positions. And that happens on the top of the absorption by the composite operator itself. And with that, more supply comes to the institutional hands, and that's what starts producing some kind of bidding war to push the price higher as supply is becomes limited. The second phase in the price cycle is the markup, or just simply an uptrend. This is where demand is in control, supply is not presented to the market in big chunks, and that's what allows the price to continue trending up. It's at the beginning of the distribution where the value composite man will start selling stocks, distributing stocks into the hands of the people that started participating in the later parts of the trend. And usually these are weak hands. And even though I say weak hands, this is the only area on the chart where weak hands might be actually consistently making money. It's in the later phases of the uptrend where the uptrend is already well recognizable, well established. There is some kind of speculative aspect to that last phase with a lot of momentum, and it's very, very easy to make money. So, and I'm sure a lot of you experience, that type of market environment. You could be thinking about like most recent ones, 2017, 2019, going into the 2020 COVID high, pre-COVID high, then most recently there was a lot of speculation, but off the COVID low, there was a lot of speculation on the way up as institutions were buying on the way up. And this initial distribution by the composite men stops the uptrend, starts creating different structures as they start selling. And weak hands are participating as if they are strong hands in the accumulation. They are buying at the bottom of the trading range. They're enjoying, certain profitability and then collapse of that profitability. And as the performance starts to deteriorate throughout the distributional area in the absolute and also in relative terms, institutions are starting to sell, and that starts producing some weakness. We start seeing some sign of weaknesses, inability of the rallies to rally back to the resistance and then collapse. And it's all institutional collapse, I would say. I mean, like, it's not necessarily that if some institutions is selling on the way down, that they have not made the profit. If some institution is selling somewhere here, let's say, they still could be profitable if they bought in the original accumulation. It's just that they are inefficient in the way how they're getting out of the position. And that's your price cycle with all of the 4 areas of the accumulation, uptrend, distribution, and a downtrend. Now, if we go into more details, this whole price cycle is definitely more detailed. During the consolidation, we're going to have different phases. And I kind of put this more or less proprietary way of thinking about how trading range unfolds. And I just want you to remember that the trading range first needs to be stopped. So, and that's the prerogative of phase A. Phase A's intention is all about stopping action. What are we stopping? We're stopping the previous trend. And that usually happens behind the aggressive selling by weak hands and aggressive buying by strong hands. This is the moment of liquidity. So the volume signature is going to increase tremendously here, and the velocity with which the price travels to that stop in action could increase, momentum could increase. As I said, volume could increase. This also produces some switch in the positions by professional traders. And ultimately, that not only stops the price from going further down, but that also reverses the price and pushes the price up and produces the first change of behavior that suggests that we are going into a trading range environment. And in the trading range environment, we need to do 3 things. We need to define the bias of that trading range. We need to define the timing of when the price is going to leave the trading range. And we need to define the character with which the price is going to travel in the trend. And it's extremely important concept. Originally, when I introduced it to my students, it was really hard to grasp character. Why do we need the character? How do we actually define from the price action what kind of trend we're going to have? But this is a very important skill for us to have, and we'll talk a lot about this in the WTC2 class. Then we go into, after the stop in action, then we go into the preparation mode. And usually phase B is going to construct that preparation mode, and phase C is going to have that final test of the supply or demand, depending whether you are in accumulation or distribution, and would finalize the final involvement of the composite man at the level of the support. So if the price tries to go down and tries to reverse, it only is reversing because composite man is stepping in and at the lower part of the trading range starts buying, absorbing the stock. And because of that, phase C has its own local stop in action testing, and from that, the price starts going up. And when the price starts going up in phase D, it's a go phase, all right? So this is where the trend is starting to be established. It's emerging and establishing itself, and we see how the character changes. So the buy-in could be more aggressive and could produce a much better price result with the price moving up in a much freer manner. And the whole concept behind the synchronization of between effort and the upward result is very visible. Not only this is the best rally, but also the best reaction. And from there, we only have a confirmation of the uptrend. Well, the same happens during the distribution. First, during the stop-in phase, which is phase A, we are seeing supply increase, and usually this supply comes from strong hands. Usually that is going to be a value CO types that are going to sell into the strength, and we'll discuss why they do this in the second class. And then that not only stops the price action, but also produces a change of behavior, which again is suggestive of what? A switch of the environment from trending to non-trending, a trading range. And again, in the trading range, what are we looking for? We're looking for the identification of the bias. We're looking for identification of the timing and character out of for the price out of this trading range. Again, all of these concepts is something that we will be studying during the semester. Preparation in phase B, and phase B could take different shapes and forms. What we're looking for there is availability of selling or buying, and what kind of price result that selling or buying could potentially produce. And then to conclude the preparation phase, phase C as the final test of the demand at the level of the resistance. Would the price continue to the upside in a sign of strength manner with the backup that follows and then confirmation on the breakout, or would the price actually upthrust and then fail back into the trading range? Those are the questions that we would pose to ourselves at this point. And then the go phase, phase D, a sign of weakness, where the reaction is the best reaction in the trading range. Attempts to go up are much, much weaker than the previous reactions, and that defines the change of character. And it's being confirmed by the next breakdown in the already established downtrend. Right? And even that picture could be much more complicated, as the price cycle is not just a single line. It's not just 4 areas of accumulation, uptrend, distribution, and the downtrend. And it's not just one accumulation and one distribution. It usually will contain quite a few accumulation or reaccumulation ranges, and then distribution and redistributional ranges. And again, the beauty of this methodology is that it allows the flexibility of the variation on the price structures. So basically, the method is saying you can't think linearly in terms of what kind of variation on the price structure we're going to have. But it also allows a very linear kind of like engineer almost type of thinking of how the trading range should unfold. Are there any specific recurring steps that should occur in the trading range that we would be able to recognize by reading the chart? And the answer to that is yes. And that's the whole beauty of the methodology. And that's what we're studying. Could we find that each trading range, regardless of the bias even, is going to start with the stopping action? Yes. Could we find that the stopping action is going to have its own climactic action and its own local test of that and its own local change of behavior after the climactic action? Yes, yes, and yes again. So if that's the case, that's our linear conceptual approach to how we're going to act as those Wyckoff events start to unfold and we recognize them in phase A. And then let's say phase C, phase D, regardless of the bias as well, is going to have the same type of linear sequence of events that's going to happen. First, we're going to test the final supply. Let's say if this is an accumulation in phase C, and then phase D should produce a change of behavior that is being followed by a confirmation on the backing up action, and that concludes a change of behavior, a change of character for us, suggestive that we're going to have a continuation to the upside. By the way, this spot right here, the actual confirmation after the change of behavior has happened and we have the backing up action, is the highest probability spot at the beginning of the uptrend, which a lot of students disregard, but I always point your attention to it. If you just want to have a very high positive expectancy of between wins and losses, you should most definitely consider this particular confirmatory spot as the one to use. Your win to loss ratio could improve drastically and almost instantly. Okay. Let me see some of the questions here. Yeah, and I usually answer the questions as we go through the class. This is the first class, so there are quite a few people, so I'm disregarding some of the questions. But just bear with me. In the second class, I'll be answering more questions. But let's just see what you guys got for me so far. Phase B and phase C look similar. What's the difference from Rajat? Actually, phase B and phase C are quite different. Even though there is a concept here in phase B and phase C of testing at the level of the support, what is going on in those phases is quite different. Phase B could be divided and should be divided into two parts, part one and part two. The first part is usually going to be somewhat more resemblant and reminiscent of phase A, where volatility is still pretty high, and there is a lot of buying and selling that's going on. And then phase B is what I call exhaustion. So to me, the whole intent behind phase B is to get to the point of the exhaustion by weekends, and which leads us to the to phase C final test. That's how I look at phase B. And then phase C is the opportunity for strong hands to behind the local liquidity to accumulate more shares. And that produces the final test on the structural level at the level of the support. So as you could see, the intentions are different for phase B and C, and also the way how they both unfold also different. But good question. Would you have a short-term accumulation within a longer time frame distribution? Yeah, this comes from Mohanad. Absolutely. So there is a fractal nature of the way how these patterns unfold. And again, by patterns, I don't mean the trading ranges that look the same, right? What I mean is concepts unfold the same way. You're going to have first the stopping action in phase A, then you're going to have, let's say, some kind of cause building through exhaustion in phase B. Then you're going to have final test in phase C, and you're going to have emergence of the new trend in phase D, and so on and so forth. So those concepts are going to repeat in itself. Wyckoff events are going to be repeating themselves, but the variations on the price structure are ultimately going to be very different. So with that, could we have a shorter term accumulation within the longer time frame of the distribution? Absolutely. If anything, there is a very common mistake, let's say somewhere here in the second part of phase B in the distribution, where we see reaccumulation type of characteristics. What are those? Volatility is going down, downward spread is diminishing, upward spread is increasing, supply is decreasing. These are all characteristics of a potential anticipation of for the rally. But what kind of rally we're going to have here, that's going to be a big question. In the distribution, we might go into the upthrust action. We might go into the upthrust event, but then in the distribution, the price most definitely will reverse and will continue to the downside. In the accumulation, we are going to have an ability of the price to hold on to its gains in the upper part of the trading range as a backup action, and then a confirmation with the breakout that we're going to continue within the uptrend structure. Okay, interesting questions today. What's the difference between change of behavior and a change of character from Astrometa? So we will be studying this in a lot of details in the next class, next Monday. So join us for that. But really quickly, a change of behavior is something that is happening differently. So let's say like we are having the best rally in the trading range, that's a change of behavior. And that's why the most recent rally in the market, we are calling a change of behavior. But this change of behavior is not a change of character in terms of the structure, right? So until we actually observe the reaction that is different than any other reactions that we have seen in the trading range, and that is confirmed by the breakout, we can't say that we are done with the trading range and now we are in the uptrend. And that's kind of like that difference between change of behavior and change of character. Again, the same question from Joshan. Okay, I'm most definitely mispronouncing the name, so I apologize. Does the sprint always happen in phase A, in phase C? So if we are talking about, let's say, kind of like legacy materials, then yes, phase C is the only place where sprint is going to occur. But thinking about the material and talking to different colleagues, we have developed an idea that a sprint type event could happen kind of anywhere, right? So we could say that a sprint type event, and see how I'm saying this, a sprint type, not a sprint type event, which could be a minor sign of weakness in this case, occurs in phase B. That is a possibility. A sprint type event also could be associated with some kind of bar by bar analysis. So let's say like we see a bar like this, which has some kind of sprint characteristic relative to the previous low of the bar and then recovery from there. This could be a sprint type event. So there are quite a few new modernized definitions of what the sprint is and where it could occur. And again, we could most definitely study different type of sprints, different spots where they could occur. In WTC2, we're going to build the whole technique based on the identification of the sprints and the upthrust. Let me remind you that our beloved David Weiss, who passed somewhat recently, coined a phrase that goes like this: you could make a living by trading sprints and upthrusts. There is a lot of truth to that. Okay, so what else? Okay, again, yes, we'll study the change of behavior and change of character, so please join us for that. Do these phases apply to all time frames? Day trading, swing trading, long-term campaigns from Derek? Absolutely. Yes, so everything is fractal in this way. You could even go to tick data and do the same thing. Once the WTC Part 1 is completed in December, when will the next WTC Part 1 be run? From Brian. Yeah, we have 3 semesters, Brian. Fall semester, but that starts today. Spring semester that starts in January, and then summer semester that starts usually in April. You could join any of the cycles. You also could buy on demand. Like we have a lot of people come to us and they say like, I don't want live classes. I want all of the material at once because I'm going to go faster. I want to be done maybe like in a month's time. So you could buy on demand the previous cycle on demand and just study it like that. Okay, so what else here? Is spring a good point to buy? There are multiple points where we could buy. Spring could be one of them. Last point of support could be one of them. Test of the spring could be another one. Test of the shakeout could be another one. A sign of strength bar could be another one. Last point of support could be another one. Backing up action and the breakout out of the backing up action could be other 2 points. All of these points of entry will be discussed into the end of this course, and even more so in WTC2 class. Can Wyckoff methodology be mixed with the order flow concept from Darren? Absolutely. I personally do not specialize in the order flow, but we've had quite a few students that kind of like do that type of combination. And I think that if you have a really good foundation in both of the techniques, and especially in the Wyckoff method itself, it just gives you such an incredible edge. Okay. All right, I think that's it. Let's continue. We're at 450. So here's an example of the price cycle. So this is what Hank called a principle within the principle, a price cycle within the price cycle. You could see how there are some smaller cycles, cyclical cycles, right? So there is a cyclical causality when Steve Jobs in 1996 comes back to Apple. And what do we see? What do institutions do when he comes back? Great news for the company, great news for potential increase in revenue. So what do institutions do? They come to the stock and they start participating in it. And you could see this from the volume signature, from either the volume spikes or the consistency of the volume increase as the price does what? Goes up, goes up. So what is it that they are doing? Are they really selling or are they buying? Well, most definitely buying. And then if they are buying, what kind of buying is happening here, characteristically? Is this for the long term or for the short term? So all of those questions could be addressed, and we'll show you exactly how we would be addressing those. And as we have a cyclical causality, we most definitely will have cyclical effect, which means a markup phase for us. A cyclical causality in terms of the distribution will lead to the cyclical effect as a markdown or a downtrend. And then you might have a much larger structure. So this is a whole structure. This structure could be divided into maybe 3 or 4 big phases. The first one was when Steve Jobs left and Apple was still considered, a very innovative company. There are some reaccumulation elements here, but then when investors started to see what Steve Jobs actually meant for the company, we see that there is a lot of weakness as they distribute their positions. Then we're seeing again an accumulation where Steve Jobs comes back, and then outperformance and suggestion of the further outperformance. Market event in 2000 off the top. If the market does not fall down, then think about how the stock like Apple that is outperforming the market at that time, how it's going to behave. And then just continuation to the upside. So some of the trading ranges are somewhat complex, right? So you have reaccumulation, distribution, accumulation. You could say like this is a distribution as well, and then reaccumulation again. In some instances, we will see that institutions love the stock so much, and it's already in so many strong hands that they have nothing to do but actually to buy on the way up. And you could see this from the volume signature, and you could see this from the price action as well. And then suddenly they're buying less, and they're buying even less. And you could make a judgment of the trend activity just based on that. Institutions still very actively participating in buying, or they are just already just holding the stock and not presenting it to the market. You could go to a much lower time frame. You could go even to the intraday time frame each day, and you will see the same price cycles. Okay, another announcement for those of you who wants to join our community. The best way to do that is just to sign up for our weekly newsletter. This weekly newsletter is completely free to you. What do we deliver there? We deliver our weekly market update analysis on different assets. We also notify you about any of the new videos that we post or blogs or bias game or any other announcement that we have. Please check out Wyckoff Trading Method YouTube channel as well. We have, I think, over 150 videos there, on different topics of education. You could find, the videos on the PNF. You could find the videos on scanning. You could find the videos on anatomy of the trade, market updates, some classes that we had and we posted, conferences, interviews. There is a lot of free educational material on this channel, so check it out. And for those of you who would like to see our analysis almost instantly, but still after the market updates in classes, you could sign up for Wyckoff Analysis handle on Twitter. We're posting our analysis there. We're posting any announcements about any upcoming events, and also the bias game is being run on Twitter as well. Behavioral market analysis. So this is the discipline that I've created for our students in order for us to better understand the market participants, their intentions, and how do they influence the price action. So by the definition, behavioral market analysis is the studies of market participants' behaviors in the context of a price structure. And here's that legacy definition of strong hands and weak hands. So usually any investor and or retail public trader who is trading in harmony with the price structure movement is going to be considered strong hands. And then weak hands, the opposite, disharmony. The trader or investor who is in disharmony with the current price cycle. And usually we're going to see that in the moment of high liquidity and the stop-in action in phase A after the downtrend, this point will be associated with the extreme point of fear and capitulation by weak hands, and also will be associated with the first signs of intelligent accumulation by strong hands. As we go into the emergence of the uptrend, it is going to be associated with the accumulation by early institutional trend adopters. So not all institutions will see this as a good selection for them at that point of time. Their models and plans of actions could identify this as a better selection later on in the uptrend. So there are different types of institutions that come to the market at different structural spots. And then most definitely the weak hands will be selling or short-term trading or being inactive during the emergence of the new trend. And that inactivity comes after a lot of disappointing kind of like ins and outs in profitability that produces mental fatigue and emotional withdrawal from the asset. And that happens right during the emergence of a new trend, and they do not participate until approximately 1/2 of the trend. This is where the trend becomes so recognizable. They are saying like, I can't ignore this anymore. I have to go in and make money. Ironically, as I said, they will make money. We can't in the last stages of the uptrend. But then as the uptrend gains a lot of popularity, gains a lot of speculative character, and the first signs of intelligent distribution by strong hands starts to occur, you're going to have a lot of supply spikes that either stop the price from moving further up or they produce a meaningful change of behavior, which is going to look like the reaction on the increased supply and increased downward spread. At the same time, extreme point of excitement by weak hands. And again, we kind of go through the same process. Active exchange of shares or contracts or crypto assets during the first phases of the distribution. In the later stages of the distribution, where the emergence of the downtrend occurs, there is some value buying, and usually that value buying is at the bottom of the trading range, but it's going to happen by weak hands. And they are the only ones who are supporting the stock at this point of time. Their strength is not that great, so at some point the price just should break down and should, on increased supply, capture all of the stop losses that the weak hands would have, whether those weak hands institutional or retail, it doesn't really matter. And then strong hands will be distributing already on the way down. By the way, kind of like an anecdotal story. I keep telling you a lot of stories about students, how they come, ask specific questions, and so on and so forth. So as you could see, I kind of been around teaching this material for quite some time. This is probably going to be, cycle 35 plus for me teaching this material. Questions repeat because the human nature is the same. So we have the same mental pitfalls. We have the same questions about those, and so on and so forth. So a very common questions from many students is, I put my stop loss, and then this stop loss is always being hit. I think the composite operator is on me. Please say yes, write it down. Say yes if you ever been in that situation and if you have thought this way. Did composite operator ever, whenever, triggered your stop loss and you had to close the position with, a loss? Yeah, of course, all of us have been in that situation, but maybe not all of us have thought this way. But I mean, we obviously experienced, some losses associated with the price going against us, hitting our stop loss, the position is closed. And then the way how we address this moment is extremely important emotionally for us. For somebody who's going to say that, oh, the institution saw my order and they triggered it because that's what institutions do. That's what the Composite Man does. I want to ask you a follow-up question. What was the size of your position? Was it 100 shares? 1,000 shares? Did you trade 10,000 in that position? Did you trade 1,000 in that position? Did you trade 1,000,000 in that position? Have you traded 10 million in that position? Do you see where I'm going with this? Composite operator does not care about you or your existence in the marketplace. Composite operator does not care about you carrying 100 shares or 1,000 shares, or let's say several thousand shares. It's just not their level. It's not their size. I mean, as a money manager, I have to establish the position that's going to be a minimum of 500,000, $1 million, $5 million, something like that. And for much larger funds, hedge funds, it's going to be way, way more. They're going to be thinking like, I need to establish a $10 million position. So let me chase this guy who has 100 shares put on, and he or she has a stop loss at this level. Do you see how ridiculous this thinking is? And it stops us from thinking about the most important things, and that is, what is the current bias and where my stop loss should be logically? Where are those points of liquidity where strong hands have bought before and the price will never go to that level? That's what we should be thinking about the stop loss. So whenever your stop loss is being hit, first and foremost, think about your way of thinking about it. And stop thinking that the CO is actually, pushing the price to your stop loss level. This is the mentality of weak hands. Putting the responsibility on someone else but yourself. All right, we'll talk more about this later on during the course, but kind of like an anecdotal story that happens each semester. So I just want to supersede this and talk about this right now. Okay, let's continue with our behavioral market analysis. Who are the market participants? We said that we are usually associate them with the strong hands and weak hands. Usually that would be associated with some kind of, institutional and public hands, which I said absolutely not true. I don't even know, why, we are continuing delivering this material this way. I think, in my opinion, this is so incorrect. maybe 100+ years, it was absolutely correct when you would have one campaigner like Jesse Livermore, and he would be the composite man. He would be driving the prices up. He would be testing different price levels, driving the price down and up. But in today's world, we can't really say. So here's the idealized behavior by strong hands and by weak hands. The strong hands will be buying on the way down and during the trading range. And we usually would say that those type of buyers are going to be long-term campaigners. They see a long-term value, so they are value investors. They are the ultimate CO. Then at the emergence of the trend and at the earlier stages of the trend, institutions will be buying, and strong hands still will be buying, and that's what produces that switch into a different character and conditions, and that's what pushes the price higher and higher. Then institutions, or rather strong hands, will become inactive. As they have bought, what else to do? Just sit on your hands, enjoy the uptrend. You could trim your position, you could take some profits, you could add to your positions, but basically you're just sitting on the trend until you see earlier signs of selling by the value investors who have bought at the beginning of their accumulation. And usually that will stop the trend, that will create some kind of price structure, and then institutions that are strong hands and recognizing that change in behavior, they will be selling. And they will start selling by capitulating their positions, either partially or altogether, and that will produce those breaks to the downside. On the contrary, weak hands are always going to be associated with some kind of, emotional behaviors around their trading. As the price goes down and they are in a position, they will be capitulating into the selling climax. And this will be the point where strong hands are coming in and aggressively absorbing all of the supply that has been presented by weak hands. They will be selling and maybe occasionally buying within their accumulation, but by the time the accumulation is done, they will become inactive just because emotionally they're exhausted, their P&L is negative, or they are completely wiped out, and with that they become inactive. They become only active in the speculative part of the uptrend, and this is where they're actually making the money. And this is what keeps them in this game. You probably have heard, or even yourself said, told the story to your friends, or you maybe heard it from your trading friends, the story of how much money somebody made during the speculative phases of the trend, and then they just kind of like losing it after that. So this is pretty common. So, and then not only they are buying on the way up and making money, but then they are buying and they're losing money. And then they are buying and they're or holding on and they are losing the money in the downtrend. All right, examples of this concept. This is Apple monthly chart, and this is strong hands. So what do we see? We see from the volume signature that there is a lot of buying off the bottom here. Again, Steve Jobs come back to Apple, more favorable outlook for the product line creation, for the revenue that's going to be brought with this product line. Change of management, change of product line, increased revenue obviously attracts a lot of strong hands, and they are buying at the bottom and then on the way up, right here, all of this. The same happens here after the market collapses. There is a lot of buying on the way down by value investors that produces decreased buying and decreased selling at the same time. And then as we go up, we still see how the volume signature increases. And we still see that there is some presence of institutions even further down the road in the uptrend after 2009 reaccumulation low. But the volume is undeniably showing that institutions are putting a lot of money in this particular stock. And that's what we are studying in classes is the understanding as to how to read the chart, understand not just the bias, the environment that we are currently in, but also the motives behind the institutional behavior. And we want to trade alongside the strong institutional hands. That's our purpose. Well, if this was the monthly chart, look at the weekly chart. Again, the same Apple, 1996, 1997. This is where, again, announcement of Steve Jobs coming back comes, and you see this spike in price in the volume signature. Is this public? Is this weekends? No. Weekends are extremely depressed here after the downtrend, and retail is probably a little bit scared to step in and produce a long-term campaign. There might be swing trading, there might be intraday trading, but not necessarily long-term campaigning. And then after that, you could kind of see how the final test at the lows in phase C produces continuation and then reaccumulation and then continuation again into the market top in 2000. So the price cycle just repeats on fractally on different time frames. Here's a 2-hour chart. I mean, like we went from 1 month to a week and now to 2 hours. Still a trading range. Still, we see some buying on the way down as price falls. Some buying on the way down as price tests, and then some buying on the way up as price leaves the trading range, and that attracts more of the followers. And now here we're not necessarily saying like, oh, those are long-term campaigners that operate in this way. They could be additionally buying shares, but a lot of the momentum traders, a lot of the intraday traders are going to be using this time frame, and a lot of them will be buyers in this time frame, and it's going to end this in the same way. As institutions become inactive, there comes a moment when the value traders that have bought at the climactic action, at the secondary test, at the sign of weakness here, they will start selling. And that will stop the price from going further up, or temporarily stop from the price from going up. Strong assets, so higher highs, higher lows, still in the range, which is upsloping range right here, and then into the upthrust action where selling happens again. So institutions again presenting that supply for the second time. This time, the price not only stops but reacts, and not only reacts in the same way, but actually breaks to the downside. So at this point, high probability point of entry for the potential continuation, and then there's some selling on the way down as well. So as you could see, price cycle exists on different time frames, in different time frames. You could use Wyckoff methodology in different time frames with different assets, and so on and so forth. So kind of like also a very common question. Okay, let's continue. Let's discuss market participants. Who are they? I usually would talk about institutions and public. We would talk also about strong hands and weak hands. But if we would take, let's say, all of the institutions and market participants just in general, we're going to find that the CO is the institutional contrarian investor. It's usually a value investor. So in here, I want you to think more about like Warren Buffett type of the investor. When does Warren buy? Well, obviously when he sees the reasons to buy and when his methodology is saying like, yeah, this is a good buy. But in a lot of cases, Warren buys during the market declines, like this latest position that he has established in Occidental, right? So that was a very considerable position. But think about the market environment where he is actually making this big purchase. It's during the market downtrend. That's his kind of like the most valuable time. Their size is pretty huge. Their time horizon is from secular to cyclical. So think about Warren Buffett holding the position for like a decade or even longer, like generational position for like 20 years or so, and cyclical positions. So they most definitely looking for the liquidity that is going to be associated with the cyclical low. They're looking for long-term value, short-term liquidity, and contrarian sentiment. And that's why a lot of the CO types are going to be value investors or the contrarian investors. There are limitations. They're too big in size, so they cannot really come in with their size and then the next day come out. If they're coming in, they stay in for a while in that position, even if they are producing some kind of losses. They want to have low turnover of their portfolio because, again, big size, big commissions, and also those type of institutions usually will have some kind of performance matrix for their clients. The clientele of those funds prefer the portfolio not to be very volatile, so meaning that they want less turnover. And then tax applications. Long-term positions over the year or short-term positions under the year. That has been a big draw for the long-term campaigns by the institutions are earlier. Right now it's less important, but still there is some importance to that for sure. What is their edge? Time horizon, right? So if you're thinking secular to cyclical type of campaigns, then you are going to have a lot of opportunities to come in during the unfolding of the trading range. You are going to have the best pricing long term if you are truly wait for those market drops of, let's say, 20 to 30 to 50 to 70%, where the price is depressed significantly and you have enough cash to participate. They have long-term trends as the horizon and long-term absolute trends in terms of the price and relative trends in terms of the performance. And they have a very deep knowledge. This is their job. This is not, a hobby. This is a 9-to-5 job. So they develop a really deep understanding of how the market works, or they hire people to do that for them. But they are still visible on the charts with the extreme volume signature, so it's very easy to read their presence with the points of the or pockets of the liquidity. So that's also very easy to find their presence when we look at the chart. You could also find their presence in the visualization of the absolute and relative trends. So if the price is trending up, most likely institutions are going to be present there. If the relative trend chart is showing outperformance and the uptrend on the relative basis, then institutions are there. And in the long-term volume signature, like I've shown you on Apple charts. Examples: the ultimate composite operator, itself, Warren Buffett, PIMCO, BlackRock. Those are big operators in the markets that have very, very big size. Institutional trend followers, and those are going to be our smaller institutions that have a lot of the performance-driven products behind them. So like pension funds, insurance companies, investment banks, mutual funds, hedge funds, registered investment advisors. They are still relatively big. They are oriented towards the growth. So they usually open their positions with the emergence of the trend, where when their systems actually catch and capture that emergence of the trend, they are going to get out on the break of the trend. They are looking for the long-term value and short-term liquidity. Their time horizon is about the cyclicality of the business cycle itself. There are limitations is that a lot of them are performance-driven. So their clients or the demands by the clients will define their behaviors. And, just for the last 3 years, I've been co-managing a hedge fund, and I could see that. I could see how there are demands that basically puts you in such an uncomfortable corner almost, where you cannot do this or you cannot do that. And it's beautiful for us retail traders because if we understand how limitations are are present for, let's say, hedge fund managers, you could exploit that, and you could know where they're going to come into the position and where they're going to give up the position, and you could build the leverage around those increases of momentum and decreases of volatility. They will be concerned about the assets under management, low turnover of the portfolio, and tax implications as well. Their time horizons is going to be long-term trends. Their edge is going to be their time horizon, more cyclical time horizon, long-term trends, and deep knowledge as well. They're going to be visible on the chart in absolute and relative trends, long-term volume signature, and momentum buying and selling. Next, market participants, professional traders. So this is the trader either that works for the contrarian investor and trend institutional trend follower, or maybe works for himself, herself. Usually those type of traders are going to be momentum driven or mean reversion traders. They are of medium and small size. Their time horizons is daily swing trading or intraday. They are looking for some kind of overbought, oversold condition and momentum. Their limitations is going to be that they produce too many trades before our commissions have collapsed high commission, short-term taxation that is going to be unfavorable, and lower size. But their ultimate edge is the quickness with which they can come into the position and then get out of the position. They will be visible on the chart through the momentum signature, through short-term volume signature, short-term liquidity, and short-term swing signatures. Those are usually proprietary traders, retail traders, registered investment advisors. And then retail traders. Finally, we come to a more common ground here. They are usually going to be momentum mean reversion or breakout traders with small size, with some kind of daily swing or intraday time horizon. The strategies that are very common at this level are going to be breakout strategies, point of excitement, a type of strategies that usually are going to be associated with what are you trading? Oh, let me look at this chart. I find it appealing. I'm going to trade it as well. Their limitations is that they're sentiment driven. So this is how we are measuring the depth of the oversold and overbought conditions by the sentiment, and we could extract the sentiment from the chart reading itself. Again, something of an advanced concept, but I will definitely show you later on how we could do this. Their knowledge is usually lower and their skill is usually lower than of professional traders. Their edge is quickness and ability to change the rules. This is a very, very important item on the edge list. They are not that visible just because their volume signature is not going to be that pronounced unless you're in a big herd community like meme stocks, maybe with some kind of social media leader driving, the buying or selling, or maybe retail traders behind, strategies that have a lot of followers like IBD, CanSlim, 2 million plus traders trading this methodology. Then you have, a significant size. All right, so those are the market participants. And they will most definitely behave differently at different market spots, right? So for instance, again, weak hands will be selling on the way down. They will not be buying on the way up. But value buying buyers will be willing to step in and to produce some buying. And trend followers will start buying at the emergence of the trend. And then as we go through the reaccumulation, there might be some profit taken by value buyers. There might be some buying by the trend followers and buying by the weekends. The weekends throughout the trading range will cease to participate, but the trend followers actually will hold on to their position and actually add on the way out. So effectively, we are going to go through the cycles where weekends are buying and then selling, producing the loss for themselves, but they're producing liquidity needed for institutions to come in and to acquire more and more and more. So by the end of the uptrend, majority of the supply will be in strong hands. And then that supply will start being distributed first by the value investors, and then will start being distributed by the trend followers, institutional trend followers. Whereas the weak hands will be buying and holding on to their positions, even after the breaks, in anticipation and hope that the price will come back and produce some kind of winning position for them. How could we see this on the chart? Well, again, reading the price and volume gives us that information, and there is plenty of information if we want, to read it like that. For instance, all of the volume spike is suggestive that we are observing some not only increase in selling, but we observe also increase in buying. What does the price do all of the time that the price comes to the support? Well, the price stops, reverses, and then rallies. So what does it mean? It means that there was some kind of buying. So who is buying that? Institutions. What kind of institutions? Well, those contrarian investors. How do we know that? Because they usually would be buying at the bottom of the trading range. And then once supply has been observed and it's been transferred to strong hands, that's when the price starts to go up. And when the price starts to go up, volume increases again. Now we see visibly demands coming in a lot, and we're just seeing the market participants that are following the market, that are following the price, that are buying on the way up as the trend starts to emerge. We could see the same process buying at the bottom here in the second trading range with all of these volume spikes. And then we could see how the momentum traders are starting to come in with the increased volume signature as the price breaks out and it starts traveling up. Then during the distributional process, as there is so much excitement in this area, as the weak hands are finally participating and they're finally making money, the value investors, the CO, start selling into strength. So behind this big volume spike, it's not just the increase of the demand, but the increase of the supply. Therefore, selling is increasing. Selling might not stop the price from going up right away, but it might slow it down, right? So we see how momentum starts to diminish. And then as they keep selling, and we see that selling in the consistency of the volume signature and specifically the supply in this area starts to increase, for the first time, we're seeing how the downward effort is increasing and the downward result is increasing as well. So we're seeing the synchronicity between the downward effort and the downward result, which ultimately suggests that some kind of either profit taking or distribution is taking place. Then later on, we're seeing that very tricky moment where in phase B, or the second part of phase B, we see exhaustion by both supply and demand. So both are going down, and because all of the sides are taken, whether selling or buying, and that should usually produce some kind of rally. We're rallying, and as we rally, what do we see? Something similar to what has happened at the buying climax. Stop in action, loss of momentum, and then finally reversal and continuation to the downside. As the price starts to go down, trend followers to the downside are establishing their positions, or they're still closing their long position, and that converts their market orders into sells, and that produces that more extensive decline. So everything happens in the same way. Everything happens conceptually with the same idea of the active exchange of shares between strong hands and weak hands at the points of liquidity, at the points of overbought, oversold conditions. And that's what creates the price swings, ups and downs, ups and downs. Okay, next announcement, and we are almost at the end here at 5:30. Wyckoff Tape Reading Lab. So this is an advanced class. Some of you are gonna say like, oh yeah, this is for me. Check it out on the YouTube channel first. If you truly want to learn how to read the chart, start with the Wyckoff trading course, this course, and then go to the tape reading lab, because tape reading lab I conduct together with William Reardon. He is an amazing chart reader and tape reader. And both of us go into extremely deep discussions about the charts. So in a lot of instances, students complained that it was too advanced, they wouldn't understand our conversations. So again, for those of you who are beginners, intermediate, and even advanced traders, Wyckoff Trading course is to start. But you could definitely check this out. And then we're coming to the homework. For those of you, again, who signed up for this course, or for those of you who's going to sign up, our next discussion next Monday is going to be about a mandatory assignment. So please read this article. I want you to read this article. So it's a mandatory homework, anatomy of a trading range. And then, if you have any questions, please accumulate those, and we'll address at least some of them during the next session. With that, let me see if we have any final questions, guys, on anything, whether this is about the course, how to sign up, or maybe some questions on the content, and we could talk about this. Again, I want to reiterate that this session is being recorded and will be posted on our Wyckoff Trading Method YouTube channel tonight. And with that, let's just see if we have any questions at this point. Okay. Okay, looking forward to the remainder of the course from Dimitar. Okay, yeah, absolutely. Looking forward to joining from Brian. Okay, looking forward to working with you. Let me see if we have any other questions. Okay. Can you continue to differentiate tradable setups or your opinions on setups for intraday traders, seeing as I am one, from Said? Yeah, for sure. I mean, like, if we would be talking about specific markets, there is certain specificity. So for instance, if you are an intraday trader and you trade like myself, index futures, right? So ES and Q, then you will for sure know that there is a lot of seasonality during the session. So you have to read the volume in a specific way. You can't read the volume like you're reading the volume on the daily chart. You also will know that the high of volatility is probably going to be in the first hour or so, a lunch hour, and then conclusion of the session that could have the continuation of the established trend, and so on and so forth. So your setups are going to become slightly different, but again, conceptually, you still will be thinking the same way. What is the current environment? Therefore, what are my trending signals and what are my counter trending signals? And based on that, based on the environment, how much of the extension do I have for my trending trades? How much of the extension do I have for my counter trending trades? What are the points of the add-ons? What are the points where I take the profits, and so on and so forth? So there is a lot to that. So you could check out actually some of our on-demand classes that are on swing trading, intraday trading, long-term campaigns. So all of those differences are discussed there. Okay, next question. When you say demand at the bottom, that is green bars, right? Or could it be as well red? So I usually put on the chart two colors, green and red. Why? Because I want people to see more clearly up days and down days. A very legacy definition of the up days and up days, it's buying and selling. We go a little bit further more into the details. If there is a volume spike, then there is always emergence of the opposing force. So we could be having a down day, but demand most definitely coming in. So you'll have to see if there is some kind of follow through to the opposing force. So for instance, like today was the day when the volume was pretty high, and with, let's say, ES or NQ, and yet the price did not follow through to the downside a lot. So what does it tell me? It tells me that demand was present, but by the result of the whole session, I could say that it still could not produce a meaningful move to the upside. So we need to wait and see if there's going to be still a continuation to the downside. And I said that everything looks a little bit weaker short term. So would we just continue to the downside, or would we actually be able to reverse? Will the homeworks be difficult, from Tajay? I think it depends on your level. So if you're like a total beginner to the technical analysis or a total beginner to Wyckoff, it might be challenging, but it's doable. I mean, we've had so many students that did not know technical analysis or Wyckoff, and they still were able, to go through the homework and complete it. There could be some initial kind of like, how do I do this? And you have to go through multiple sessions, multiple homeworks to establish how things needs to be done. We do review this, in the next session. So it's not like I give you the homework and that's it. There is no commentary. No, each homework is going to have some kind of feedback. Either it's going to be a live feedback in the class, or I'm just going to give you the slides and you're going to self-review. How many sessions are the January course and how much is it? From Henry. January course, which is the spring semester, is also 15 sessions. And it costs the same, $9.98. Other than your YouTube videos and material on your website, a question from Brian, is there any other prep material you would recommend to read before joining WTC1? For example, read David Wise's Trades About to Happen, or anything else on the methodology. So for WTC1 level, there is a required material, especially if you want to join us. So Jim's Forte, Anatomy of the Trading Range, is a must. It's a required trading. Bruce's blog is somewhat of the requirement trading, but there are quite a few of those, so it's hard to read all of them before the course, but at least start reading them. Obviously, our YouTube videos that you mentioned, Brian, and also Hank's book, chapters 3 to 7. The name of the book is The 3 Skills of Top Trading. You could find that book under the free resources on our website and just buy it off Amazon or any other sources. For WTC students, which are more intermediate advanced students, I would be suggesting to read David's book, Trades About to Happen, and start concentrating more on charts themselves. And I will give you more pointers as to what specifically to do with the charts and how to train yourself. You mentioned an exam. Can you say more about this? Yeah, so for the first time, we are introducing this semester an exam. This exam will be taken by students who are taking this course at the beginning, so within the next week or so. This is going to be such an easy exam. Just basically, we want to establish the baseline to your knowledge, and then at the end of the semester, you're going to take this exam again, and you will see how much you have improved. So that's kind of like the purpose of this exam, but this is going to be the first semester. Do you share your trades with students or share potential trades? Yes, all the time. In each class, I don't necessarily have a specific intention, oh, let's talk about my trades, but I more often than not bring the trades that I'm in right now, discuss, either specific stock or let's say some kind of market trades that I've had. I could show you some of the trades on the chart and so on and so forth. So yes, we discuss those trades a lot. Okay, I think that's it in terms of the questions and comments. Well, thank you guys so much for being here. Again, for those of you who are interested in signing up, do this earlier rather than later. I would sign up today, tomorrow, and start working on the homework. So meaning that go, download that article by Jim Forte, start reading it with the pen. So with the pen, make a lot of notes. Start going through Bruce's blogs, read Hank's book, and so on and so forth. There is plenty of things to do. And then in the next class, I'm going to give you the homework with charts. So, start preparing yourself for that. And if you guys have any questions, absolutely reach out to us. Our email is wyckofassociates@gmail.com. Either Nancy, who's our COO, could answer any of the administrative questions, or I could maybe, here and there answer some of your questions. And I'm looking forward to working with you. Yes, it's not an easy course. I mean, any of the students will attest to that. But as you go through the testimonials that you could also find on our website, please note what people say. There are a lot of stories that go like this. I have taken this course and I've done this and this and this in trading. My favorite story is probably comes from the student that have taken the course and during the duration of the course found the way to make enough money to pay for the college education, to fund the college education for two of his kids who are 5 and 8, and also buy the house. I mean, like, obviously he starts with probably a considerable amount of money to begin with, but that kind of could give you an idea of what kind of stories I enjoy listening from students. Really looking forward to start the semester. I've been on the vacation, so I feel a lot of energy, and I'm looking forward to just dissect all of the material with you, to go through the markets for 15 weeks, and keep talking, Wyckoff, keep building knowledge as a foundation for you, and also start developing your skill of recognition. Okay, last question. There is another session tomorrow at the same time. Is it same sharing as today? No, that's actually going to be covering Wyckoff Trading Course Part 2. So this is a continuation to the course, on Mondays, WTC 1. So please come, check it out. It is, WTC 1 is the prerequisite for tomorrow's course, and WTC 2, but it gives you a sense of where we're going to go, which direction we're going to go. So please do attend that, or just sign up and we'll send you the link tomorrow night. And with that, thank you guys so much for being here. Thank you for all of your questions. Thank you for all of your comments. The link for tomorrow, Carlos, you could find on our website. Just go to our website and find Wyckoff Trading Course Part 2. And yes, Sergey, thank you. Looking forward to working with you. And with that, thank you guys so much. I'll see you in the class next Monday, or I'll see you in tomorrow's session, or I'm looking forward to seeing in your emails with any of the questions that you have. With that, thank you again, and bye-bye.